Now, let's talk about accounting for natural resources. This is where we're going to be looking at expending or figuring out an expense allocation method to use for allocating natural resources. So, in this case here, the natural resources, this is assets that come from the earth. So we're going to be looking at depletion of those natural resources. So what we want to do is spread the allocation of the resource cost to expense. Now, when we're looking at depletion, the only depreciation method that's going to make sense out there in order to account for natural resources is going to be units of production. So just remember that. When you're looking at depletion or the use of natural resources, allocating natural resource costs, we're going to be looking at the units of production depreciation method. Now, how we're going to come up with something like this, it says here, assume that an oil well costs $700,000, estimated to hold 70,000 barrels of oil, no residual value. 3,000 barrels are extracted during the year. Now, what we're going to have to do here is figure a depletion per unit. So that's always my cost minus my residual value divided by total estimated units. In this case, it's going to be my cost of $700,000 minus the residual value of 0, and then divided by 70,000 barrels, which is my total estimated units. So I'm coming out with depletion per unit of 10,000 or $10 per unit. I'll multiply that $10 times 3,000 barrels extracted during the year. And again, my depletion expense is going to be $30,000. So with the depletion entry, we can book it as either depreciation expense, or in this case, we can go depletion expense of the oil reserves, debit depletion expense of $30,000, and credit accumulated depletion of the oil reserves of $30,000. And again, this is the method that we're actually going to be using out there when we're accounting for natural resources. So again, with the accumulated depletion, again, it's another contra asset account that's out there. And again, very, very similar to accumulated depreciation. And so you can record natural resources on the balance sheet. You've got the cost of the oil reserves, which is $700,000, and then you've got less accumulated depletion of those oil reserves of $30,000. So my net book value of the oil reserves is going to be $670,000. Now, which of the following is an expense that results from the usage of a natural resource? Is it A, depletion? Is it B, amortization? Is it C, depreciation? Or B, obsolescence? This case here, we're looking at A, depletion. So the correct answer on this one, when we're dealing with natural resources, is going to be depletion. Number 21. A coal mine costs $1,003,000 and is estimated to hold 54,000 tons of coal. There is no residual value. During the first year of operations, 11,000 tons are extracted and sold. Calculate the depletion expense for the first year. Well, in this case here, my depletion per unit is always going to be my cost minus my residual value divided by estimated total units. So in this case, I'm going to take 1,003,000 minus 0 divided by 54,000 tons. And so I'm going to come up with a depletion per unit of $18.57 per ton. So I'm going to multiply to find out my depletion expense for the year, I'm going to multiply the 1857 times 11,000 units, which were extracted and sold, and I'm going to come up with a depletion expense of $204,270. Correct answer is D. And again, this problem here, number 22, is just almost a carbon copy of the last problem. So in this case here, I need to figure out my depletion per unit, which is going to be $526,000, my cost, minus a residual value of 0, divided by how many tons? 36,000 tons of iron ore. So I'm going to come up with a depletion per unit of $14.61. So my depletion expense for the year is going to be my depletion per unit of $14.61 times we extracted 7,500 tons of ore So I'm going to multiply 1461 times 7,500 tons, and so I should get depletion expense for the year of $109,575. Now, let's move on to accounting for intangible assets. Now, intangible assets, as I've stated, have no physical form whatsoever, and they are patents, copyrights, trademarks, and other things. Now, those are examples of intangible assets. Now, with the intangible assets, we need these assets. They are assets to us because they are an economic resource that we need in order to run our business. Now, with intangible assets, they mention they're purchased and recorded at cost. There's no doubt about that. Now, most of the purchased intangibles are expensed through something called amortization. Now, this amortization is the allocation of the cost of the intangible asset to expense over its useful life. So we've got, for physical assets, we've got depreciation. For intangible assets, we're using amortization. And then for depletion, we're using depletion expense. These are all the same type of expenses out there for allocating the cost of the asset to expense over its useful life. Now, it mentions here that only intangibles with a definite life are amortized. We'll talk more about that in a little bit. Intangible assets with an indefinite life are tested for impairment annually. And again, impairment occurs when the fair value of an asset is less than the book value. And at this point, that's when we'll record a loss on that asset, is when we've determined that that asset has been impaired. Now, when I start talking about some of the intangible assets, we'll talk about, the impairment test and amortizing, or how we're going to go ahead and amortize that asset. So don't worry about that. Now, patents. Now, patents is an intangible asset. It's a federal grant that gives you an exclusive 20-year right to produce and sell an invention. Now, with this patent here, it's an important part of your business. It's an intangible asset. Now, I'll explain why. Now, I'm a drug company, and for years, I've been trying to develop the pill that will cure all cancers. Now, obviously, cancer is not curable at this point, but if I came out with a drug that could actually cure all cancers, just think of that one. Now, I've spent billions of dollars of research on this drug, and the FDA has reviewed my drug, and it's gone through tests and things like that. And this drug is truly legit. This is a drug that will cure all cancers. Now, my competitors out there are looking at me going, their jaws have hit the ground. Number one, that I actually came up with the cure for cancer. And number two, they're chomping at the bit, hoping that I don't file a patent with the government. And if I don't do that, then everybody's going to buy my drug, and then they'll copy my formula and get in on the action. Now, what a patent does for me is this. This protects my product, and it gives me about a 20-year right to actually sell that product just through my company. Now, you're probably saying, well, Dennis, that's not competitive, that's not competition, that's not capitalism. I say bunk. Here's why. For all those years, I was putting out billions of dollars of research dollars to come up with this drug, and I found it. Okay? And really what I'm recovering with this patent is basically all my research and development costs that I incurred to create the drug. Plus, obviously, I'm making a bit of a profit now because, look, I should get a profit on this. So, again, a patent is going to protect my business, that I'm the only one that can sell that product. Now, with a patent, what the accounting for a patent is just very simple. It's going to be a debit to a patent for $200,000, and in this case, it's going to be a credit to cash. Okay, for at least for this entry here. That's all there is to it. Okay. Now, with a patent, if I've determined that that patent is going to be good for 5 years, all I'm going to do is I'm going to do some amortization expense on this, and I'm going to figure out my amortizable cost, which is usually my cost minus my residual value. Now, residual value in most intangibles is going to be zero. Why? Because there's going to be no value to this asset at the end of its useful life. So it's going to be cost minus residual value of zero divided by a useful life of 5 years, my amortization for this patent is going to be $40,000 a year. And that's what I'm going to book as my entry. So again, I'm going to make a debit to amortization expense, and then I'm going to make a credit to the patent at this point, or I can make a debit or a credit out there to accumulated amortization. In this case here, it really doesn't matter. GAAP is okay with this. So again, I can make the credit to the patent itself, or a credit to accumulated depreciation to figure out the book value of my patent. Again, you can go either way on this one. GAAP is fine with it. Now, let's talk about copyrights and trademarks. Copyrights, again, these are exclusive right to sell a book or film or whatever. And again, with a copyright, this is granted to the life of the creator plus 70 years. So suppose I wrote a book, and suppose I died in 2019. Basically, I have copyright protection on this book until 2089. A trademark, again, this is a distinctive identification like the Nike Swoop or the McDonald's Golden Arches. Franchises and licensees, I'm not really too worried about. But goodwill, this is another important intangible asset that's out there. And this is the value paid above the net worth of a company's assets and liabilities. Now, usually you're going to record goodwill when you buy another company. So in this case here, suppose I went out and bought the Jackson Company. Now, I looked at the value of the assets and liabilities of the Jackson Company and determined it's about $600,000. Well, I turn around and pay the Jackson Company $1.6 million for the value of the company. Now, the difference between the cash that I paid and the net worth of the company's assets and liabilities is $600,000. It's $1 million. That is going to be defined as goodwill. Okay? And again, it's the difference between the cash that I paid and the market value of the assets required. Now, in this case, goodwill is always going to stay on my books. We're not going to amortize goodwill. Okay? So again, that's the difference that's out here. Now, again, we can see what happened here with goodwill. My cash to acquire Mocha was $10 million. The market value of the market value of the net assets was $8 million. So again, the $2 million difference, that's going to be goodwill, the difference between the cash that I paid and the market value of the net assets. So again, what I'm going to have here to record that purchase of Mocha is a debit to assets or whatever asset accounts that are out there, a debit to goodwill for $2 million, credit to liabilities of $1 million, and a credit to cash of $10 million. So again, the reporting of the intangible assets, there'll be an asset on my books, probably towards the bottom of the asset section of the balance sheet. And then you got the related expense. The plant assets will be depreciation expense. Natural resources is depletion expense. And then intangible assets will be amortization expense. So number 23, intangible assets. Does it represent assets for which the market value cannot be determined? Is it B, are not recorded in the books because they have no physical substance? C, convey special rights from patents, copyrights, trademarks, and other creative works? Or is it D, all are correct? The best answer on this one clearly is going to be C, because this is going to convey special rights from patents, copyrights, and trademarks. A and B, no, that's not the definition of an intangible asset. So really the clear answer that stands out for the whole thing is C. Number 24, regarding impairment of intangible assets, which of the following is incorrect? Impairment A, impairment occurs when the fair value of an intangible asset is less than the book value? No. Intangible assets are impaired when there has been a permanent decline in the value of the asset. Exactly. Now, B is the correct answer on this one. Now why would it be D? In this case here, we talk about impairment. If any impairment occurs, the company records a loss in the period for which the intangible asset was acquired. Now, I didn't go into the story back here. You remember that story where I bought the company for $1.6 million and the market value of the company was worth $600,000. Now, that $1 million is goodwill. Okay? Now, every year, I'm going to be determining, has there been any changes or any cause that I should write off goodwill, or goodwill is not a value or is not an asset anymore? Well, the reason why I bought the company is because the person that runs the company, the president, we'll call him Chris, he is truly the company. And so I told Chris that I'll buy your company, but you're going to run it. Okay? And Chris was fine with that. Now, every year for 5 years, we've had a great working relationship. Now, year 6 comes along, and boy, the relationship just blows up. Chris just walks out on me. He doesn't want to be a part of the organization anymore. He walks out. I tell him, good riddance. I can run your company better than you. Well, guess what happens at the end of the first year? I couldn't run the company better than him. So the company just literally went belly up. And so there's no value to that company that I bought anymore. At that point, goodwill is considered impaired, and in which case I'm going to write off the whole $1 million in year 6. When the impairment occurs, that's when we write off goodwill. So the answer on this one is D. Number 25, intangible assets. Do they A, have a definite life? B, are recorded at cost when purchased externally? C, are always expensed through amortization? Or D, do not include goodwill? Well, in this case here, the correct answer on this one is B, because you're always going to record the intangible assets at cost if you buy them externally. Number 26, businesses record goodwill, A, when they enjoy an outstanding reputation and loyalty with customers, B, if they acquire another company at an amount higher than the market value of its net assets. I'll tell you, this one right here, I'm going to stop right at B, because that's the answer right there. Again, if you acquire a company at an amount higher than the market value of its net assets, that's considered goodwill. 27. Which of the following items should be amortized? And again, amortization always comes with intangible assets. And the intangible assets out there are goodwill, patents, copyrights, trademarks. But which one of B and C is it? Now, goodwill is always going to be written off. It's not amortized at the time that it is considered impaired. Now, on the amortization side, you can amortize patents and copyrights and trademarks over their useful life. So the correct answer on 27 is definitely C. 28. Which of the following accounting methods is generally used to compute amortization expense? Normally, this one's going to be straight line. Okay? So in this case here, the correct answer is C on that one. Now, let's take a look at the last section in this WebEx session, and we'll take a look at the asset turnover ratio to evaluate business performance. Now, asset turnover, what I want to take a look at here is I want to take a look at the amount of sales generated for each average dollar of total assets. So really what I'm looking at here is how efficient I am at buying my assets based on the sales that I'm generating. Okay? Now, in this case here, with the ratio here, we're always going to divide by my net sales, and we're going to divide that by average total assets. Okay? Now, average total assets being beginning total assets plus ending total assets divided by 2. Now, this is kind of a measure out there of how efficient are we at running our company. Meaning, do we have, in this case here, with a high asset turnover ratio, we're generating a high amount of sales with a low amount of average total assets. That's a great thing. Some companies out there have a fair amount of sales, but they have an ultra-high asset base. So their asset turnover ratio is probably going to be lower. So let's take a look at this in this case, for Kohl's 2015 annual report. Now, in the asset turnover ratio here, we're going to take net sales, in this case for 2016 of $19,204, and we're going to divide it by average total assets. So we've got 13,606 plus January 1, 2015 of 14,333, and we'll divide that number by 2. And so I'm coming up with an asset turnover ratio of 1.37 times. Now, is that good or bad? What you really want to do here from Kohl's is compare that asset turnover ratio to past years. Is the asset turnover ratio higher than past years? That's good. But if this current year's asset ratio is lower than past years, then we might want to take a look at the size of our assets, or either that or with the size of our assets, can we generate more sales? And also, again, look at your competitors also. What are your competitors doing? And then compare yourself to your competitors. Now, the asset turnover ratio measures A, how efficiently a business uses its sales to finance its assets. Is it B, how efficient a business uses its average total assets to generate sales? C, how efficiently a business uses its net profit to finance the assets? Or D, how the ending inventory helps the value of the assets? I'll tell you right now, the only one that really makes sense out of this one, this 29 is going to be B all the way. It's how efficiently a company uses its average total assets to generate sales. Number 30, the company had net sales of $204,550 for the year ended December 31st, 2017. Its beginning and ending total assets were $83.2 and $116.5 respectively. Now I want to determine Maple's asset turnover ratio for the year ended. So let's go right to the problem. Let's go right to the answer. Now my asset turnover ratio is going to be net sales divided by average total assets. So again, 204,550 is going to be my numerator. Average total assets of $83,200 plus $116,500 divided by 2. And I'm going to throw all those numbers into the formula, and I'm going to come up with an asset turnover ratio of 2.05 times. Okay? So the correct answer on this one is D. Okay? Well, this concludes the WebEx for Chapter 9. And again, if you guys have any questions on any of this material that's out there, please do not hesitate to email me. Again, some of this material is going to be a little challenging, in particular when you start computing out your double declining balance methods, and perhaps